welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 173. On this week's episode, we have a lot to get to. Looks like the Fed has finally blinked and signaled to the market that they're ready to start cutting interest rates in September. At least that's what the market thinks if you look at the rally that we had on Friday. We're also going to talk about some of the earnings highlights of the previous week, which is Home Depot, Lowe's, Target. We'll talk about the selloff in Palantir and some of the other tech stocks and see what's going on there. And then we definitely need to talk about valuations, the Shiller P ratio. We're going to talk about insiders buying, and we're going to discuss, bring it up again, selling around a position. Had a lot of people talk to me over the past week, ask me questions about this, so I want to make sure we cover it again. So as always, get your mind right, and let's get to work. Well, welcome back to the show, everybody. Thanks again for joining me. Recording today in the new studio, trying not to feel like I'm just reading the news. It's just weird every time you change kind of the recording location. It just takes a little bit to get used to. So we look at the markets this week. I mean, so far for the year, the markets are looking pretty good. We have the S&P 500 up 10%. Close to it, 9 point something. NASDAQ's up a little bit above 11. It always depends. When you search for the NASDAQ, you have to be careful because sometimes it'll show you the NASDAQ 100, and then sometimes it'll show you the actual, composite index. So I'm usually trying to do the composite that includes all the companies. Dow Jones is up 7% for the year. That one is coming back a little bit. It has been the weakest performer of the year, pretty much the entire year because of one name, which is going to be United Healthcare, which has struggled since the death of their CEO last year. Made a lot of headway, a lot of headway on the performance of the stock, but also a lot of headlines when it was announced that Warren Buffett and Berkshire Hathaway have been buying shares of United Healthcare. And so you see that stock start to come back up. And so Warren always looking for value. And in this market, it is really starting to get pretty difficult to find value in companies, which is something that we're going to talk about a little bit today. As the market continues to make new highs, the big news for the week is going to be that early on in the week, there's a pretty good tech sell-off. There was a short seller note. Citron came out and basically said that Palantir was overvalued based on what based on the money that OpenAI is going to raise. So they compared Palantir's valuation to OpenAI. OpenAI, just as a reminder, owns ChatGPT. So they looked at that and said, based on OpenAI's valuation, this is where we think Palantir is. I not that I disagree that Palantir hasn't, run a lot this year. Obviously, it's up, almost 140%. It's been as high as up 144% this year. And with the pullback, I think it was up maybe 120% for the year. So obviously, Palantir has had a great year. But there are some things that are a little bit, when you look at Citron's, them talking about them being overvalued, when you look at their thesis there, it's a little bit, some holes there. But, one of them is the fact that they said that, they're just comparing them based on sales numbers. The fact that Palantir is actually a profitable company is a big difference. Palantir actually earns a profit. Normally, when you have a company on the open market, it's going to get a little bit higher valuation than somebody who's a private company, and OpenAI is still a private firm. So if you were to take OpenAI public and all the investors that want to invest in OpenAI could possibly invest in them, I think you'd get a higher valuation as well. But I also get it. Citron, if they're looking to short the stock, obviously they want to put pressure on the stock. They want to bring that stock down. There were also some insider sales on Palantir this week that were already scheduled. So these were scheduled back in December. But Alex Karp and I believe it's Stephen Cohen, sold shares this past week on August 20th, August 21st. So those are sales that they had scheduled months before, and those actually just came through. So they timed the way that insiders time out these sales is it's based on, they do it in advance. They don't know exactly where the stock price is going to be. It's all scheduled in that way that they don't have any kind of insider information, things of that nature. So, but it is something to keep in mind. The big story of the week, though, was the Fed blinking, the Fed showing, Jerome Powell at Jackson Hole, Wyoming, saying we're looking at lowering interest rates. And this was based on, I believe, jobs and looking at some of the employment numbers, looking at that. I mean, I think that there's, if you look at different pockets of the economy, it looks like the Fed should start to lower rates. And the market most definitely thinks so. So the market is looking at, the big day on Friday, the Dow was up 800 points. NASDAQ had a great day. I mean, all the indexes had a great day. And so when you look at that, it's like, man, that was kind of the last thing that the market needed to really start to move higher, is that you had the Fed, signaling that they're going to lower rates. And, we've had a lot of concerns that we had early on in the year. If you think about some of the episodes that we had early this year, we talked about some of the worries were the fact that we have the tax bill, what's going to happen with taxes? Well, with the big, beautiful bill, that has kind of been resolved. We've had tariffs, though that impact so far hasn't been as bad as everybody feared. And so you see company earnings come in the second quarter, and they were much better than expected as a whole. And so company earnings still look good. And so where interest rates going to be is kind of the last thing that was, on the horizon that could really make the market stumble. And so now that looks like it's going to be okay, the market is taking that as a sign of basically risk on, and let's, pile into some stocks and move them higher. I would like to point out to you that before the Fed reports, before the Fed has their meeting in September, we're going to get another jobs number on September 5th. We are going to get another CPI, so Consumer Price Index, Producer Price Index. We're going to get those reports before they report this time. And then also this week on Wednesday after the close, Nvidia, who still has not reported their earnings, Nvidia is going to report their earnings. And that's going to be very important for the technology sector and, all of the companies that are kind of in that in that realm, if you will. And so there's still some data out there. And so, there's optimism, but I would be cautiously optimistic. I mean, we have run way up from the lows that we had in April. And so it's just a time to be a little more cautious. This week we had earnings from Target. They weren't great. Target's earnings were not great. I mean, Target really needs some help. They announced the CEO's leaving. They announced the person that's going to take over for them, which I think is, really going to be good for them. The market didn't like it because it was an insider with Target. And so they're worried that, it's going to be the same old for them. And so for Target, the big issue for them is getting consumers back into the store. So how do we get consumers back into the store? And we'll see if they can do some things to drive traffic. But I mean, it's really hard when you can, just have the ability to order things, and Amazon has it on your doorstep at 7 a.m., which we've talked about in the past. Home Depot had good earnings. Lowe's had good earnings. And especially for Lowe's and Home Depot, if rates start to come down and housing starts to take off again, I mean, that's going to be a big catalyst for those stocks. So, and we'll see. I mean, it depends on how much they lower rates, how much does the 30-year mortgage rates move, where do those get, and everybody keeps wondering, like, where do rates have to be where those, homeowners or home buyers are willing to pay, but also the home buyers, which we've talked about, the homeowners that we've talked about in the past, which is we have a low mortgage rate and what do how low do rates have to get before we're willing to trade out of a mortgage that's 3.75%, 4%? Is it 5%? Is it 5.5%? I mean, obviously everybody's situation is different, but where do the numbers have to come down to where it looks pretty good? So we'll see. My concern here, and the question that I keep getting asked, I mean, this past week I did a lot of meetings. I did a lot of kind of networking things with schools and things of that nature. And a lot of the questions I got asked were, so many former students, people I know are like, man, I don't know when to sell. When do I sell? And so I want to give you some data on this. So there is a valuation metric called the Shiller PE ratio. And the Shiller PE ratio looks at where the PE ratio again, Stan, if you've been listening for a while, you've probably heard me say this, but the PE ratio is price over earnings. So the price over the stock over the earnings of a company. If a company doesn't have a PE ratio, well, that's going to signal that the company is not profitable yet, that they do not have earnings. And so, but the higher a PE ratio the higher a PE ratio is, it means that, investors are more likely to, they're paying more today for future earnings. And so the Shiller PE ratio is based on, looking at inflation adjusted. It's inflation adjusted. I thought I had a piece of paper. I printed all these pieces of paper to help me with this. So it's looking at basically, indexed for inflation. How high is the S&P 5 or not the S&P 500, but the S&P 500? How high is it relative to the earnings? And so the highest it's ever been is 44, which is very high when you think about all the companies together. So 44 was the highest, and the lowest was, years and years ago before 401k. So I think the data on that is a little wonky. But if you look at it, it's basically indexed average inflation adjusted earnings of the S&P 500 over the past 10 years. It smooths out short-term booms and busts, giving a longer-term view of valuation. Historical average is about 16. I'll get into that in a minute. Today, it's near 39. So it's actually the second highest it's ever been. The highest it's ever been is 44, which is back in 1999. Right before the tech bubble burst. And that's why you get so many comparisons between the AI boom and the technology boom. And, you get a lot of, academics, you get people that are in practice and they say, yes, but like back in 1999, those companies didn't have any earnings. Today's companies have earnings. Well, just because today's companies have earnings doesn't mean that they can't be overvalued. Right. So, but there's a couple differences between that era and this era. Back then, you couldn't make investment trades as easily as you can today. You would have to call a broker. You'd have to pay a commission. You'd have to do all that. So there's less retail investors back in 1999 than there are today. There's so many ways for you to trade. You can use your cell phone, you can use apps, you can use your laptop, whatever. You don't have to go through a broker. You don't have to pay a commission anymore. So that makes it easier for people to trade. It also means that there's more investors, there's more retail investors. Obviously, back in 1999, most of the average age of an investor was much older than it is today. So most of the, back in the day, a lot of people didn't start investing till they were in their 30s. Today, it's much younger. It's about a decade younger, with people in their 20s now being able to participate. So there's more people in the stock market. And so especially when you look at that average, Shiller PE ratio, it says 16, but that's going back to basically the 1890s. And so I don't know. I don't really buy into that average because the participation of investors in the stock market is so much higher than it used to be. Also, the 401k came out in 1980. And so I think that there's just a higher base now because there's so many investors that are invested in the stock market through their 401ks, constantly putting money in every 2 weeks or every week or whatever it is based on their payment schedule. And so if the market drops, then they're not necessarily they're not likely to sell because, they can't touch it till they're 59 and a half regardless. You also have the baby boomers who are retiring, where when they retire, they have that money locked up in that 401k. Anytime they take money out of those traditional 401ks, they have to pay taxes on it. So they're more likely not to just sell and pay all the taxes. And so I think because of that, the average of that Shiller PE ratio is going to be a little bit higher. But it does, it does give you pause. It does say, hey, the market is definitely at a higher level. Maybe I should be a little bit more cautious here. So I told you that the highest it's been is 44 back in 1999. We are now at the second highest level that it's ever been. The third highest level that it ever was back in 2021, right before the Fed started to cut interest rates. So this is after COVID, when you had all that euphoria. You had the meme stocks, the NFTs, crypto booming, everybody's getting, checks at home and you can't gamble. So everybody puts it in the stock market. Stock market starts acting like a casino a little bit. All of a sudden, we start having high inflation. The Fed starts to raise interest rates, and all of a sudden, stocks start to sell out. It's hard to, I don't know, for some people, not for me, because it was so painful. But 2022 was a very painful year in the stock market. A lot of the gains that I, currently have, and many investors have, and a lot of my clients have, is because of the decisions that we made in 2022. Those positions have come roaring back from that point. But now, for the first time, we've gone above that level. So this isn't a, panic. And it's not saying that you should be too concerned about it. But I mean, there are going to be sectors of the market that get a little, I don't know, Wolf of Wall Street meme-y a little bit, And so we just have to be careful. So you just have to be careful, be cognizant. We've talked about trading around a position. So you might have stocks that you really like, and obviously companies that you really want to be invested in. But now might be the time to start thinking about, okay, as the Fed signals that they're going to lower rates, and it might be time to start being like, okay, I'm going to take a little bit off the table. I'm going to start raising a little bit of cash. I'm going to be a little bit more cautious. Now, this could go on for a while. The big difference between where we are right now and where we were in 2021 is the fact that the end of the party in 2021 was when the Fed signaled that they were going to start raising rates. And that was the end of the party back in 2021. So today, it's much different because we're at highs and the Fed is signaling that they're going to start to lower rates, which means that stocks normally go up when the Fed is lowering rates. And so, we will see how much of the tariff revenue starts to pay down the debt, because that's going to be the big key. If the Fed lowers rates in September, the number one thing we got to watch out for is what happens to the 30-year bond. What happens to mortgage rates? The last time they cut interest rates, the 30-year bond actually went up. Part of that was because our debt, there's kind of a lot of things that go into that signals that there might be inflation and they're going to have to raise rates later. So we will see. But the Shiller PE ratio being high, normally that means that equity returns over the next 10 years are going to be lower than they have been. And so I start getting nervous when it's around 40. It doesn't mean that I want to sell out of stocks completely. It doesn't mean that, that I'm completely changing my strategy, but it does give me pause to think maybe I shouldn't be as aggressive. Maybe I should start to sell some of the profit that I've made over the past 5-6 months, especially from the April lows. And then I should be a little bit more cautiously optimistic is kind of how I'd put that. And so you just have to think about the portfolio that you've built, the money that you have, the investments that you have. Where are they? How much have they gone up? And, are we getting a little greedy with it? That's all I'm asking. Are you getting a little greedy? And so it's something to consider. And so this next week will be it'll be a big week. So we had a big Friday. Does the market continue to rally off of that news on Friday, or do investors sell into it? How do Nvidia's earnings look on Wednesday? How is that looking? And so do we have a follow through? Because earlier this week, we started selling off in the tech sector. Tech stocks started to sell off a little bit. And August, normally not a great month for stocks. September, definitely not. Usually early October. We kind of getting into this area of the market where it's not so great. So, I mean, you just have to be kind of thinking about that. So we started selling off earlier last week, and we had this big rally on Friday. So this week I'm looking for, do we have a follow through on Friday's rally? Or do the investors that were selling resume selling into kind of that good news, because we still have a lot of data that's going to come out before that September Fed meeting. But the market, what you saw on Friday, was them pricing in that Fed cut in September. So that's already priced in. So we'll just have to see. So it's okay to trade around a position. When you look at trading around a position, let's say you own a stock and you own 100 shares of it. I think the number one point I want to make to you is that it's not a all or nothing game. So if you have a stock that you really like and you want to sell some of it, you don't have to sell all of it. And quite frankly, I would tell you not to sell all of it, because if it continues to move higher, you'll get hit with FOMO really, badly, the fear of missing out. You'll be mad at yourself for selling it and it continues to go higher. So it's okay if you have 100 shares and you want to take some of that profit off the table, sell 15%, sell 20%. So sell 15 shares, sell 20 shares, and just be able to have that cash available. If it's a really good company, you're probably going to want to buy it back later. So again, you don't have to sell all of it. It's not an all or nothing game. And so many investors, especially young investors, I feel like that's like the number one thing that they do. They sell all of it or they buy all at once, all of these things. And so just remind yourself that you don't have to do that. You can sell a little bit, you can take the profit, put that cash on the sidelines, wait for things to pull back a little bit and kind of see where we go. So I got to look this number up. So I'm going to kind of fill here, but I want to show you where the market went from that Shiller PE ratio when we went from the highs of 2021 to the lows of 2022. We didn't fall that far. So we fell from 38. So the high that it hit in July of 2021 was 37.97. And then when we hit the lows, the lowest it got was back down to 28.92. And then now we're back up to 38.96. So we're almost at 39. So we went from July 2021, 37.97 down to 28.92. And that was a rough year. So that's how painful it was, just going from, 38 down to 29. And so we had that kind of year in 2022 where the market just seemed like it was falling every single day. So that's how far the Shiller PE ratio moved. And it wasn't as bad as it could possibly be. So, just a little bit of caution. I'm kind of on my soapbox here, but it's also just trying not to be too high, not to be too low, and just be disciplined, right? So we were disciplined in the April. We were disciplined when the market fell after Liberation Day and stocks kind of got beat up. And so we also have to be disciplined when the market is high, and we got to be willing to sell some things and raise some cash and kind of provide ourselves with some liquidity so that if the market does come down at some point, we will have money to put back into the market. So we'll see. Let's see how this week goes. We'll talk about it again next week. But hopefully this is valuable for you, kind of resetting expectations, seeing where things are going. But hopefully that's helpful for you. So as always, don't mistake activity for achievement, and I'll see you next time. Thanks, everybody. This podcast contains general information that may not be suitable for everyone. The information contained here should not be construed as personalized investment advice. There is no guarantee that the views and opinions expressed in this podcast will come to pass. Investing in the stock market involves gains and losses and may not be suitable for all investors. Information presented here is subject to change without notice and should not be considered as a solicitation to buy or sell any security. Right Our Equities does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstance. Past performance is no guarantee of future results.